For Entrepreneurship section of Informed Eyes Weekly Business Insights for the week 407 June 27 to July 3, 2025, we curated and summarized articles from three business magazines. The first article from Forbes shares 8 expensive investing mistakes and how to avoid them. The second article from Entrepreneur explains 6 reasons your perfect product isn't selling and how to avoid the marketing mistakes behind them. The third and the final article from Inc. describes what it's really like taking over a family business. First from Forbes magazine.
8 Expensive Investing Mistakes and How to Avoid Them, written by Catherine Brock, published by Forbes magazine on June 28, 2025. A recent report from financial services consultant Dalbar concluded that the average equity investor earned a 16.54% return in 2024. That may sound like a win, but the S&P 500 grew 25.02% in the same period. The S&P 500 is widely viewed as a benchmark for the overall stock market, which means the average investor underperformed the market by over 8.4 percentage points. The lag is surprising, given that investors can buy an S&P 500 ETF to keep pace with the market before fees. The Dalbar analysis said investors continue to underperform due to their own behavior, citing withdrawals from equity funds just before market surges. If you have $10,000 invested, an 840 basis points miss costs you $840. Repeat the same mistakes a few years in a row and your net worth is thousands below where it could be. Let's sidestep that outcome by learning about 8 potentially expensive investing mistakes and how to avoid them. 1. Not investing. Cash is important to have on hand. You need to cover unexpected expenses or income changes. Unfortunately, bank deposits don't offer the same wealth opportunities as stocks. If you want to grow your net worth, stock investing is one of the simplest ways to do it. Open a low-cost brokerage account and invest monthly in an S&P 500 ETF. Your monthly budget can be small to start, but plan on increasing it as you get more comfortable. 2. Timing the market. Timing the market is an investing strategy that attempts to predict stock prices, trends, and profit from them. Imagine knowing ahead of time that stocks would fall dramatically on Monday and then surge back on Tuesday. You would invest on Monday when prices are low and sell on Tuesday for a quick profit. The problem is that making these predictions accurately is difficult. Even professional investors have spotty records in this area. Invest consistently every month, whether the market is strong or weak, and the next time stock prices fall, challenge yourself to wait it out. Hold your portfolio the same and see what happens on the other side. 3. Following the crowd. When investors are optimistic, stock prices rise. When investors are discouraged, stock prices fall. Getting caught up in these sentiments encourages you to buy high and sell low. You can't make a profit that way. This is why famous billionaire investor Warren Buffett once advised investors to be fearful when others are greedy and greedy only when others are fearful. This contrarian approach makes it easier to buy low and sell high, which is what you want. Don't buy or sell because everyone else is doing it. If you feel the need to take action in a down market, increase your holdings in high-quality stocks when their prices are down. You'll be well positioned for gains when the market recovers. 4. Going all in. Going all in refers to spending your entire investing budget on one stock or one industry. This strategy can expose you to extreme volatility and high loss potential. It can also prompt you to make other investing mistakes such as timing the market, following the crowd, and emotional decision making. Diversification is the solution. Spread your wealth across at least 20 individual stocks plus some treasury securities if you can. Or invest in ETFs with well-diversified portfolios. 5. Paying high fees. Account fees, fund fees, and trading fees pull money away from your investments and lower your returns. You can't avoid all investing fees, but you can make sure you're not paying more than you need to. Dive into your brokerage account and funds to list the fees you're currently paying. Then look for lower fee alternatives for the account itself or your investments. 6. Skipping the research. Making investing decisions based on limited information can be dangerous, particularly if you're picking stocks. Fund-based investing strategies, the less Fund-based investing strategies are less research intensive, but you still should understand what you're buying and how you can expect it to perform. Spend time educating yourself. You could allocate a short weekly time slot on your calendar for this. Use it to research securities or investing strategies. Ask questions and find answers. The more time you put in, the better investor you'll be. 7. Getting emotional. Emotions can convince you to sell when the market is down, even though logic says stock prices will eventually recover. Emotions can also urge you to buy tech stocks at crazy high valuations, even though logic says there is a point at which their prices become unsustainably high. If you don't have a long-term strategy, make one. Document what you're trying to accomplish and how you will do it. Include your methods for making trade decisions and the criteria that make a security buy-worthy or sell-worthy. The next time you feel like making a rash decision, go to your documentation and follow the methodology you defined in comma times. 8. Investing what you can't afford to lose. Inevitably, your investments will lose value. Panic can result if the loss pinches your finances. At best, panic can push you into emotionally driven decisions like selling securities to avoid deeper losses. At worst, panic can encourage you to chase gains to recoup lost capital. That can lead to bigger losses and more panic. Build a cash emergency fund before you start investing. Use that fund for unexpected expenses so you won't have to reach into your portfolio. Also, only invest money you won't need for at least 5 years. 2 key takeaways from the article. 1. A recent report from financial services consultant Dalbar concluded that the average equity investor earned a 16.54% return in 2024. That may sound like a win, but the S&P 500 grew 25.02% in the same period. According to Dalbar, investors continue to underperform due to their own behavior. 2. 8 potentially expensive investing mistakes and how to avoid them. A. Not investing. If you want to grow your net worth, stock investing is one of the simplest ways to do it instead of depositing it in the bank. B. Timing the market, which you can't predict, so invest consistently every month whether the market is strong or weak. C. Following the crowd. If you feel the need to take action in a down market, increase your holdings in high-quality stocks when their prices are down. D. Going all in. Spread your wealth across at least 20 individual stocks plus some treasury and securities if you can. E. Paying high fees. Dive into your brokerage account and funds to list the fees you're currently paying. Then look for lower fee alternatives for the account itself or your investments. F. Skipping the research. Spend time educating yourself. Use it to research securities or investing strategies. G. Getting emotional. Document what you're trying to accomplish and how you will do it. The next time you feel like making a rash decision, go to your documentation and follow the methodology you defined in comma times. And H. Investing what you can't afford to lose. Build a cash emergency fund before you start investing. Use that fund for unexpected expenses so you won't have to reach into your portfolio.
6 reasons your perfect product isn't selling and how to avoid the marketing mistakes behind them. Written by Maureen Nethi, edited by Cara McTrain, published by Entrepreneur on June 30, 2025. It's frustrating feeling you have built a product that solves a real problem. You have spent weeks, months getting your landing page in shape, writing great copy, setting up campaigns, maybe even throwing in a few influencer shootouts. But for some reason, it just isn't working. Sales are coming in slowly, the numbers doesn't justify the effort. People are bouncing, not buying, or worse, they are not even noticing. If this sounds familiar, you're not alone. A lot of products, even good ones, struggle to get off the ground. Not always because of the product itself, but because the marketing strategy is working against it. Here are some reasons that might be happening and what to look for and what to look at before you throw your money at another campaign. One, you are too focused on features. A long list of product features looks impressive on a website, but most buyers are not looking for impressive, they are looking for something that helps them with a specific situation they are dealing with. When marketing focuses heavily on what the product does instead of what it helps someone do, it often misses the point. Walk through the actual moment a person would use the product, what's happening around them, what problem is already on their mind when they find you. That's what they care about. Two, you're targeting the wrong people or too many at once. It's common to want your product to appeal to as many people as possible, but marketing built to please everyone usually ends up resonating with no one in particular. Sometimes it's not even a case of bad targeting, it's just unclear targeting. Refining your audience doesn't mean giving up on reach, it just means narrowing your focus enough to actually connect. Once you know who is getting the most value, it's easier to build trust with the right people, and that's where growth usually starts. Three, the first impression isn't built for the channel. A homepage is not the same as an ad, and a product page isn't the same as a social media post. But sometimes the same language or design is used across all of them and it doesn't translate well. Every channel has a different kind of attention span and expectation. If the first thing people see isn't relevant to why they clicked or why they came from or where they came from, they will leave quickly and it will not be because the product is bad. Four, your content is not helping people make a decision. It's easy to forget how many decisions go into a purchase, especially for something unfamiliar. People don't just want to know what your product is, they want to know how it compares to what they are already using, what setup is involved, whether it will work for their use case, and how others are using it. If your marketing content skips over this and just asks for the sale, you might be missing the middle part of the journey. This is where things like demos, comparison pages, or case studies start to matter, not just as credibility boosters, but also helping people figure out whether this is a good fit for them. Five, you are relying too much on one tactic. Sometimes the marketing isn't failing, you are using one ad format, one channel, one piece of copy, reused everywhere. If that single thing isn't working, then everything else starts to feel like a failure too. Even if you are even if you have found something that converts well, relying on it too much can become a risk. Algorithm change, audience burnout, and if your strategy is built on one pillar, there isn't much room to adapt. A more balanced approach can mean thinking through three different ways someone might discover you. Someone might discover you: search, social, and referral, or three different types of content: awareness, education, and action. Spread out your efforts a bit, and when one thing underperforms, it will not tank everything else. Six, the product itself isn't positioned enough. Even if your product is great, if people don't understand what it is or how it fits into their life, they will not buy it. Positioning is what tells people why your product exists and who it's for. If your pitch sounds too much like every other tool or service in your space, you are making it harder for people to choose you. On the other hand, if your messaging is so different that people can't figure out what you even offer, that's a problem too. Just note that a product that solves a boring but urgent problem usually wins over a product that sounds amazing but feels irrelevant. Three key takeaways from the article. One, it's a frustrating feeling you have built a product that solves a real problem, but for some reason it just is not working. Two, some reason that might be happening: you are too focused on features, you are targeting the wrong people, or too many at once. The first impression isn't built for the channel. Your content is not helping people make a decision. You are relying too much on one tactic, and the product itself isn't positioned enough. Three, what to look at before you throw more money at another campaign are: Walk through the actual moment a person would use the product. Refine your audience to narrow your focus enough to actually connect. Every channel has a different kind of attention span and expectations. People don't just want to know what your product is, they want to know how it compares to what they are already using, what setup is involved, whether it will work for their use case, and how others are using it. A more balanced approach can mean thinking through three different ways someone might discover you: search, social, and referral, and positions well. A product that solves a boring but urgent problem usually wins over a product that sounds amazing but feels irrelevant.
What It's Really Like Taking Over a Family Business, written by Dan Furman, published by INC on July 2nd, 2025. Taking over the family business sounds like a natural next step for many people, but in reality, it's often anything but simple. Between generational differences, shifting business landscapes, and overcoming the natural perception that the title was simply given, there's a lot more to the handoff than most people think. At Soft Touch Furniture, a Girard, Ohio-based manufacturer of commercial restaurant furniture, founded in 1974, a second-generation owner is learning how to carry forward a legacy while confidently building something new, with buy-in from everyone in the building. Over the last decade plus, Megan Vickers, Soft Touch's current president, has been groomed to succeed her parents, co-founders Bob and Terry Chugadoff. Here's what she has to say about taking the reins from her parents, the lessons she had to learn, sometimes the hard way, and about why respecting the past is just as important as moving forward. What's the most important thing you would tell someone else taking over the family business? The most important thing is to listen. Don't come in thinking you need to change everything right away. There is a lot of wisdom and hard-earned experience in how the business was built, from both the founders and the employees, even if you eventually go in a different direction. You need to understand the foundation first. Did you always know you wanted to be in the family business? Actually, no. I went to school for criminal justice and psychology, but growing up I was always exposed to the business. My parents were constantly working on it, and over time I got curious about how everything ran: operations, clients, decision making, all of it. And then I realized this was where I really wanted to be. My siblings chose different paths, and I completely respect that. But my dad always sensed I had a natural pull towards the business. I think having a genuine interest really matters. Running a company is all consuming. If your heart's not in it, it eventually shows. What are the unique challenges of stepping into a family-run company? There is a strong emotional layer. You're not just managing a business, you're carrying a legacy. That brings pressure. Decisions aren't just strategic, they're personal. You need to navigate what's best for the company versus what feels right for the family dynamic. Then there is the challenge of earning respect, not just because of your last name, but because of your own work ethic, ideas, and leadership. That takes time, and it takes building good business relationships with your parents and the employees long before you take over. They need to know from their own experiences with you that the company is in good hands. From my own experience, I would say it helps immensely to work within the business long before you take over, and learn the various aspects of it from the people you will eventually lead. Did your relationship with your parents ever get in the way? Yes, and I think that's natural. First off, I love and respect my parents deeply, but when someone pours their life into building something, it's not easy for them to let go. There were definitely moments where our perspectives clashed, not out of malice, but because we simply see things differently. The key is open communication and mutual respect. I've come to see those tough moments as growth opportunities, and now that I'm older and my parents have stepped away, I have even more appreciation for everything they did. How do you balance your dad's continued advice with your own instincts? Very carefully. I have to remind myself that his advice is invaluable. This is because he's lived through market changes, tough customers, staffing issues, you name it. But I also must interpret that advice through today's lens. 3 key takeaways from the article. 1. Taking over the family business sounds like a natural next step for many people, but in reality it's often anything but simple. 2. At Soft Touch Furniture, a Girard, Ohio-based manufacturer of commercial restaurant furniture founded in 1974, a second-generation owner is learning how to carry forward a legacy while confidently building something new with buy-in from everyone in the building. 3. Here's what she has to say about taking the reins from her parents. According to her, even if you eventually go in a different direction, you need to understand the foundation first. Having a genuine interest really matters. Running a company is all-consuming. If your heart's not in it, it eventually shows. There's a strong emotional layer. You're not just managing a business, you're carrying a legacy. That brings pressure. There were definitely moments where with the co-founder, perspectives clashed. Not out of malice, but because we simply see things differently. The key is open communication and mutual respect. I have to remind myself that this founder advice is invaluable. This is because he has lived through market changes, tough customers, staffing issues, you name it. But I also must interpret that advice through today's lens.